Excellent. So let's get started. Hi, everyone, and welcome again. Thank you so much for joining us. This session looks at recent updates to the Federal Acquisition Regulation, the FAR, and what they mean for federal financial management. The FAR shapes how agencies handle contracts, funding, oversight and compliance. So when it changes, it ripples right into our day-to-day work. We'll keep it practical and high level, focused on real world impact, not legal fine print. So it's useful whether or not you are working in contracting. Here to walk us through this is our excellent instructor, Tamara Horton. Tamara brings deep experience in federal financial management, budgeting, accounting, audit readiness, and process improvement. She began her career with the Department of the Army and later moved into consulting, helping DoD and DHS agencies strengthen internal controls, prepare for major audits, and streamline their financial workflows. Today, she brings that real world expertise straight to you all today. And then Tamara, the floor is yours, my friend.
Thank you so much for that introduction, Amanda. And hello, everyone. Welcome. I'm so excited to be here with you and talk about some of the recent FAR updates that might be affecting all of us. Um, we have a couple of slides that I want to share, and we'll start off by just talking about the agenda. So today we're going to talk about the recent updates and what they might mean for you as a financial manager working within the government. Now, I don't want you to focus on memorizing these FAR citations or anything because, as we know, they are evolving. But instead, we'll look at what has changed so far and why those changes are happening, and then how the revolutionary FAR overhaul, known as the RFO, is reshaping the acquisition landscape. We'll also discuss the areas that matter most from a financial management perspective, including acquisition planning, funding, documentation, internal controls, and oversight responsibilities. And then we'll wrap up with some practical steps that you can take so that you can stay informed and prepare your organizations as these changes continue to roll out. And my goal is for you to leave with a better understanding of where things are headed and what you should be paying attention to. First, I want to start us off with a poll. Let us know what your role is in the world of the federal government. And if it's other, can you just drop it in the chat and let us know if you find yourself um, in a job that does not cover anything that we have listed here on the slides? Okay, looks like about 40% are in budget or finance, 20 in accounting or audit, 20 in program management, and then 20 in other. Let's see. Okay. Well, thank you so much for sharing that information. So I want to start, let's back up a little bit. For anyone who might be new here, what is the FAR? The Federal Acquisition Regulation. That is the government's primary rule book for purchasing goods and services. It provides a standardized framework that agencies follow throughout the entire acquisition lifecycle, which starts with planning and soliciting offers, and it goes all the way through contract administration and contract closeout. For financial managers, the FAR reaches far beyond the contracting office. I know we tend to think of it as an acquisition only framework, but it actually affects you no matter where you sit because it influences how funds are committed and obligated, what documentation must be maintained in order to prepare for audits, how payments get processed, and what evidence is needed to support all of those transactions. So even if you're not in contracting, the FAR probably affects many of the financial decisions and controls that you work with every day. One of the biggest misconceptions is that acquisition is solely the contracting office's responsibility. But in reality, successful acquisitions require close coordination between the program offices, the contracting offices, and the financial management teams, including budget, accounting, and audit. Financial managers have touch points throughout the entire acquisition lifecycle. It starts with confirming that funding is available and properly aligned with the requirement. From there, finance supports the obligations, the commitments, the payment reviews, the disbursements, and ultimately the contract closeout process to ensure that financial records are complete and accurate. It's also helpful to understand the different roles that each organization plays. The program office defines the mission needs. The contracting office determines how to acquire those goods or services and manages the contract. And then the financial management ensures funds are available, properly controlled, and used in accordance with law and policy. When these three groups communicate early and work together, acquisitions tend to be a lot more smooth with fewer delays, fewer funding issues, and fewer audit findings. So these are the three main players that I've grouped together here: the program office, the contracting office, and the financial management office, although logistics also plays a role. Now, what is the RFO, the Revolutionary FAR Overhaul? Well, it is the most significant modernization effort the FAR has seen since it was first established in the 1980s. The goal is not to rewrite federal procurement from scratch, but it's to simplify and streamline as well as modernize the FAR while keeping the statutory requirements intact. This initiative was directed by the Executive Order 14275 and OMB Memorandum M25-26, which called for reducing unnecessary regulatory burden and making the FAR easier to understand and use. Now, here are some objectives that were mentioned directly in the EO and in the OMB memo that followed. You'll notice that they kind of all point in the same direction. We want to use plain language to make things easier to understand and navigate, remove unnecessary complexity, speed up acquisitions where it's appropriate, and encourage greater competition and innovation. And for financial managers, it's important to recognize that the RFO is not changing fundamental fiscal law or appropriations requirements. So your responsibilities for sound financial stewardship, including your internal controls and proper use of taxpayer dollars, remain the same. What does change, though, is how acquisition professionals are navigating and applying the FAR to accomplish those responsibilities more efficiently. Now, the RFO is not changing all at once. It's being implemented in phases. In phase one, that's going to be the immediate implementation phase. The FAR Council has released model deviations. These are texts that agencies can adopt through class deviations. That allows agencies to begin using the new streamlined language right away while the formal rulemaking process is still underway. And then phase two is where the traditional rulemaking process is coming into play. Proposed changes are published for public comment, feedback is considered, and then the final rules get incorporated into the FAR. So if you're interested in being involved in that process, there are still openings for taking public comment, and you can find that directly on the RFO resource page that we will share a little bit later. But if you're in FM, the key takeaway is that I don't want you to solely rely on the published FAR because it is evolving. And your agency could have already begun operating under the approved class deviations that supersede portions of the existing FAR language. So it's important for you to stay informed about your agency's implementation guidance and continue monitoring the final rules as they get issued, because they might affect your internal policies, procedures, internal controls, and possibly training. So as I mentioned, the FAR affects more than just the contracting office. While financial managers don't write contracts, they do play a critical role in funding, execution, reporting, oversight, and ensuring good stewardship of taxpayer dollars. So one important thing to remember is that faster acquisition does not mean less financial discipline. If anything, it requires a little bit more financial discipline. The goal of the RFO is to make acquisitions more efficient, not to reduce requirements for proper funding. So we got to pay attention to documentation requirements, internal controls that ensure that we are good stewards of taxpayer dollars, and then audit readiness requirements, of course. So the question is probably in your mind, how do these changes affect funding, oversight, controls, and auditability? Well, every acquisition decision has financial consequences. So it's important to understand how the evolving guidance is impacting your responsibilities, and that's going to depend on the role you do and where you sit. The transition itself is also introducing risk because during this period, you may see inconsistent practices, weak documentation, or poor coordination simply because organizations are operating under different versions of the FAR. You cannot assume that every contract is following the same rules. It ultimately is going to depend on when that contract was awarded. So, my recommendation to you would be to always verify whether the acquisition is governed by the original FAR, an agency class deviation, or the finalized RFO language. And I want you to keep in mind, too, that systems often lag behind policy and procedural changes. Contract writing systems, templates, clause libraries, and even SAM representations may not immediately reflect the latest changes. So before you rely on any system generated language, you're probably going to want to verify the applicable FAR version, check for any approved deviations that might apply, and then check the contract clauses that actually govern the acquisition. There have been a lot of things that have actually moved out of the FAR as well, because they were more procedural and rule based. So they have been put out into what they call strategic acquisition guidance documents. And we'll talk a little bit more about that later on. But essentially, just know that whatever transaction you're looking at, if it's related to a contract, you're going to want to check where does it fall based on the original FAR, the agency deviation, or any future finalized FAR changes, depending on when that contract got awarded. Now, I want to ask you, how familiar are you with the RFO? Tell me by answering the poll. Okay. Most of you, the vast majority of you, have said you've heard of it but don't know much about it. Great. I'm so glad you're here. So, one of the biggest changes in the RFO is not a specific rule change, it's kind of a philosophy change. FAR Part 1 is emphasizing that the acquisition system should focus on delivering mission outcomes while being a responsible steward of taxpayer dollars. And you'll notice several themes throughout here. Mission first, the value of time, flexibility, commercial solutions, increased competition and innovation, as well as a focus on integrity and transparency. The idea is to empower acquisition professionals to exercise sound business judgment rather than simply following over these prescriptive processes. In the past, the FAR has been very, very prescriptive in nature with a lot of procedures. And so that's why a lot of that has been moved outside of the FAR. And what's really staying within the FAR are the regulatory requirements. And one concept that is especially important for financial managers to pay attention to is best value. Best value does not mean lowest price. Used to be, we looked at it's called lowest technically accepted solution. That would be something that is the lowest price available that meets the requirement. That's out the window now. Now we're looking at best value because we want to make sure that we have the best capability for the value to the government that includes performance, schedule, technical capability, as well as risk, long-term outcomes. We're not just looking at the short term here. And we want to make sure that that price is still fair and reasonable. So from a financial management perspective, this reinforces the stewardship portion. And stewardship is not about spending the least amount of money. It's about helping the government make informed decisions that achieve the mission while protecting taxpayer resources and getting the biggest bang for our buck. And sometimes the lowest upfront costs end up being the most expensive option over the life of the contract if it results in delays, poor performance, or additional risk. So keep that in mind as we go through these slides and as you continue to learn about the RFO. Best value does not equal lowest price, which is kind of the mindset that we used to have when it came to acquisition. Now I'm going to go through some specific areas of the FAR. We started with FAR Part 1. We're going to go through a few different areas, and you can look these up yourself if you want. You can just go to acquisition.gov, or you can even just go to Google and type in FAR Part 2, and then you can follow along if you'd like. FAR Part 2 is all about definitions. And so these definitions have real world operational and financial implications. Many acquisition decisions begin with a definition. For example, how the FAR defines a micro purchase or a commercial product or service or a purchase order is going to help determine which acquisition procedures apply. It also is going to help determine what approvals are required, what documentation must be maintained and for how long, and what internal controls might need to be in place. While financial managers may not be making these determinations themselves, they are responsible for supporting the funding, the obligations, the payments, and the oversight that follows. That's why it's important to understand how these definitions affect your work. The bottom line, though, is that definitions drive decisions. So keep that in mind because they influence how agencies buy, how they document things, and how they apply internal controls, and ultimately how they execute the funding and account for those appropriated funds. And what might appear to be simple wording changes could have downstream effects throughout the acquisition and financial management process. FAR Part 8 is all about federal supply schedule changes, which is a very significant structural change within the RFO. The procedures have been moved from FAR Subpart 8.4 to an external document called the GSAR. That's the GSA regulation, and it's now going to be in Subpart 538.71. Since GSA manages the Federal Supply Schedule program, this change allows GSA to update ordering procedures more quickly without having to revise the FAR itself. So hopefully we'll see some of that streamlined. Another major shift is that the guidance has been simplified. Instead of having separate ordering procedures depending on the type of requirement, there's now a more unified framework that relies more heavily on professional judgment, which is something you'll hear more about going forward. Professional judgment. Instead of the purchaser, the contracting officer, or the internal purchaser, depending on if we're making a GPC card purchase, they have more flexibility in making a determination on where to buy or who to buy from instead of just being forced to go with the lowest price. So we're giving more trust. We're extending more autonomy to the people who are actually making the purchase. The focus is less on rigid steps and more on determining the best way to obtain the products or services while achieving the best value for the government. So, for example, under the old FAR, buying 100 laptops and acquiring IT support services with a performance work statement followed different procedural paths. Under the new approach, both acquisitions follow the same ordering framework. The questions become, what does the agency need? What's the best way to request quotes? How should those quotes be evaluated? And what represents the best value to the government? For financial managers, one important clarification is that the dollar threshold has not increased, other than what we saw with the annual increase for thresholds, which we normally see at the beginning of every fiscal year. And that's just based on inflation and projections and things like that. But instead, RFO removed the special approval requirements for certain single award BPAs, blanket purchase agreements, that cost over $100 million. That is probably going to lead to increased use of larger consolidated BPAs. It'll help make funding coordination, multi-year spend planning, and execution monitoring even more important than it already is. Because a BPA for something over $100 million is going to be quite extensive when it comes to documentation requirements and internal control procedures. Now, you're also going to want to pay attention to your agency's internal procedures because they might change as well. So check your approval workflows, your templates, and any desk guides that reference the old FAR 8.4 procedures or the former $100 million trigger, because they might need updated to reflect the new guidance if that hasn't already been done internally. FAR Part 12 is all about commercial buying, which is one of the major themes throughout the RFO. They want to expand the government's use of commercial buying practices wherever it makes sense. And the goal is to reduce unnecessary government unique requirements and make it easier for commercial companies to do business with the government, as well as encourage greater innovation and competition. But it is important to remember that commercial buying does not mean reduced oversight. The procurement process is streamlined now, but the government's responsibility for sound financial management hasn't changed. Commercial acquisitions still require valid funding, proper obligation of appropriated funding, adequate supporting documentation, and ongoing contract monitoring. So financial managers still play a key role in ensuring those fundamentals are in place. So from a financial perspective, you'll continue to focus on questions like, is funding available for this specific purpose, time, and amount? Is the price fair and reasonable? Are our cost assumptions sound? And ultimately, the key question remains the same. Is the government receiving reasonable value for taxpayer dollars? Because even though the process may evolve, the requirement to be good stewards and remain accountable is going to be constant. FAR Part 16 is all about contract types. Another important theme in the RFO is giving acquisition professionals greater flexibility in selecting the contract type that best supports the mission. Rather than defaulting to a particular contract vehicle, the emphasis is on choosing the approach that balances mission outcomes, innovation, and risk. So from a financial perspective, contract type matters because it directly affects financial risk, funding requirements, and oversight responsibilities. We keep hearing a lot more about firm fixed price, and firm fixed price is something that's being emphasized with the RFO because it places more cost risk on the contractor, while a cost reimbursement contract shifts more financial risk to the government and typically requires greater financial oversight, cost monitoring, and documentation, and possibly even earned value management, depending on the amount the contract is awarded for. So as we see an increase in flexibility, so does the importance of understanding the financial implications of those decisions. But your key takeaway here is that financial managers should be involved early in acquisition planning, understanding how the selected contract type, understanding how the selected contract type affects funding, execution, and oversight will help to ensure the agency can achieve its mission while maintaining strong fiscal stewardship and sound internal controls. And there's a bunch of different contract types that you can look at. And if you go into FAR Part 16, you can learn about the different types and understand the different requirements as it relates to oversight and documentation. Depending on the contract type, the financial risk is going to be different. While the contracting officer is going to be the one selecting the contract type, the financial implications affecting funding, execution, oversight, and ultimately financial stewardship relies on the financial management community. And we'll talk about each one briefly. With a fixed price contract, the biggest risk is defining the requirement correctly. Once the price is set, the government has greater cost predictability and less exposure to cost growth because it's fixed, right? However, poorly defined requirements can lead to contract modifications, which can increase costs and delay performance, which is why clear requirements and ongoing performance monitoring are so important. With a cost reimbursement contract, the government's financial risk is much higher because the government is responsible for allowing costs incurred by the contractor. These contracts require careful cost monitoring, strong internal controls, and sufficient funding throughout performance. When we talk about time and materials, the primary concern is oversight. Since payment is based on labor hours and materials used, agencies need strong monitoring to verify that billed hours, labor categories, and materials are accurate, reasonable, and well supported. So the big takeaway here is that every contract type is shifting risk differently. Some are more on the government side, some are more on the contractor side, but all of it has financial risk of some type. And financial managers play an important role in understanding those risks and ensuring that appropriate funding and internal controls, as well as oversight, these are in place. FAR Part 17 is about special contracting methods. And this is a good example of the overall philosophy behind the RFO. The language has been streamlined a good bit, and duplicative guidance has been removed, but the core contracting tools like multi-year contracts, option years, and interagency acquisitions remain the same. The goal is to simplify the rules, not eliminate the financial discipline. So for FM, these contracting methods are especially important because they often create financial impacts that extend well beyond the initial award year of the contract. When you're dealing with a multi-year contract, you know that exercising an option could require oversight for the next 5 years, depending on if they exercise each option year. But whether you're dealing with a multi-year contract or exercising an option year or supporting an interagency acquisition through like a MIPR or something, you still need to validate funding availability, including time, purpose, and amount, and understand the impact on current and future year obligations, as well as maintain adequate documentation. The RFO is encouraging acquisition professionals to use sound business judgment when selecting the best contracting strategy, but the flexibility doesn't change the underlying fiscal requirements. Agencies must still comply with appropriations law, ensure funds are available before obligations get made, and properly manage options as well as modifications and amendments to contracts and any other financial commitments throughout the life of the contract. But the biggest takeaway here is that increased acquisition flexibility requires greater coordination between the 3 offices I mentioned earlier, not less. Strong communication between the program office, the contracting office, and the financial management team is essential to ensure acquisition remains both mission-focused and fiscally responsible. And with the additional flexibility and the additional sound judgment that has been provided to purchasers, you might see some creative contracting options be awarded in the future instead of just the usual ones. FAR Part 30 is another good example of the RFO philosophy because we want to simplify the regulation without changing the underlying requirements. The CAS, or Cost Accounting Standards, are established by statute and the CAS board, not by the FAR. So while Part 30 has been reorganized to make it easier to digest and navigate, the actual CAS requirement has not changed. Contractors still have to comply with applicable standards, and disclosure statements are still required where applicable, as well as the existing clauses remain largely unchanged. What has changed, though, is the organization, because Part 30 now follows the acquisition lifecycle from pre-solicitation through post-award administration, which makes it easier to navigate. Some of the detailed procedural guidance has also been moved to the FAR Companion and Practitioner album, while obsolete sections and outdated references have been removed. For financial managers, auditors, and cost analysts, the biggest impact is knowing where to find the guidance and making sure your organization's policies, checklists, desk guides, and training materials point to the correct sources. And I'll show you a list of resources that you can click on the links if you want. You can bookmark them so that you know where to find this stuff. But the bottom line is the administration of CAS has been streamlined, but the requirement has not changed. So financial managers are still going to play a critical role in supporting cost oversight, audit activities, and maintaining documentation that supports cost-related decisions throughout the acquisition lifecycle. FAR Part 31, Updated Contract Cost Principles and Procedures, is another important section of the FAR for financial managers because it establishes the rules for how costs are treated under certain contract types. Now, the RFO has streamlined the language and removed unnecessary regulatory text, but the core framework remains the same. The concepts that we've relied on for years, whether a cost is allowable allocable, and reasonable are still the foundation of contract cost principles. One misconception I've heard is that removing language from the FAR somehow gives contractors more flexibility to charge costs, but that's not true. A shorter FAR does not mean more costs become allowable. The rules are still in place, and agencies are still responsible for reviewing those costs, supporting any questioned costs, and maintaining appropriate documentation for those costs. And you can take a look at FAR Part 31 and learn all about what are allowable, allocable, and reasonable costs for yourself. So, from a financial management perspective, your responsibilities haven't really changed as it relates to this part because you'll continue to evaluate costs against applicable requirements, maintain documentation that supports those cost decisions, coordinate with contracting and audit organizations when questions come up, and update your internal policies and systems to reflect the new FAR organization. So the bottom line is the FAR may be a little bit smaller, but cost accountability is not. Strong financial stewardship, sound documentation, and thoughtful cost oversight remain just as important as ever. FAR Part 32 is where acquisition and financial management really come together because it governs how contracts are financed and paid. The RFO reorganized and streamlined this section by removing duplicative procedural language, but the underlying financial responsibilities are the same. The rules surrounding advance payments, performance-based payments, progress payments, invoice requirements, assignment of claims, and contract funding limitations all remain into effect. Although the limits might have changed based on the recent changes with FY 2026, and we'll probably see them increase again, as we normally do to account for things like inflation and economic conditions. But this is especially important for financial managers that support incrementally funded contracts, which are multi-year efforts, or contracts that are approaching their funding limits. Those situations require careful coordination to ensure funding is available, that obligations are recorded correctly with the correct line of accounting, and work doesn't continue beyond available funding. So your role is going to be largely the same. You're going to verify that funds are available before the obligations get made, monitor contract funding status and burn rates, support timely invoice reviews and payments, and maintain the documentation needed to support financial decisions. Strong oversight also helps prevent potential ADAs, Anti-Deficiency Act violations, before they might occur. So keep in mind that streamlining the FAR does not change the government's responsibility to properly fund, pay, record, and oversee contract obligations. Good financial management remains just as critical as ever under the new structure, if not more important, because of the additional flexibility. FAR Part 42 is another good example of the RFO's overall approach. The biggest change is not what agencies are required to do, but it's where the guidance is located. The section has been reorganized to make post-award contract administration easier to navigate, with several areas consolidated and renumbered. So if you have anything bookmarked or memorized, you're going to want to look at that again to make sure that you know where the latest and greatest is. Some of the things you can see here, indirect rate costs have moved, disallowed costs, contract performance evaluations, and forward pricing rate agreements all have new FAR citations. They're still within 42, they're just now in a different order. In addition, some standalone subparts, such as correspondence and visits and post-award orientation, were eliminated as part of the streamlining effort. But the important point is that the underlying processes haven't gone away. The contract audit services still exist, and indirect rate negotiations are still going to occur. Procedures for questions and disallowed costs are still in place, and agencies remain responsible for contract oversight and maintaining appropriate documentation. The practical impact is that organizations should review your SOPs, templates, desk guides, audit programs, internal processes, and training materials to make sure that they are up to date. You may find references to FAR citations that no longer exist, and if so, my recommendation to you would be to bring that to the attention of whoever is in your chain of command responsible for updating your guidance. Updating those references now could save a lot of confusion later on. But Part 42 changed the roadmap more than the destination. It's largely the same, it's just more streamlined and a little bit in a different order. Financial controls, audit coordination, and contract administration responsibilities remain largely the same. And the guidance is just now a little bit different in the organization. FAR Part 49 is about termination updates. This slide actually includes the actual timeline changes that can have a direct financial impact. Although contract termination isn't the same as contract closeout, the two are closely related. A terminated contract often cannot be fully closed until the settlement process is complete. The longer that process takes, the longer obligations may remain on the books. Under the proposed changes, contractors would have less time to submit inventory schedules and termination settlement proposals, and the timelines for requesting extensions are also shortened. The goal is to resolve terminated contracts more quickly and reduce unnecessary delays, as well as return the money through the obligation process being reversed so that money could be reallocated somewhere else where it might be needed. So this is good news. Faster settlements means that those obligations can be reviewed and released sooner. Remaining funds can be identified for DOBs and financial records can be reconciled more quickly. It also helps reduce the number of unliquidated obligations and dormant contracts that linger from year to year, improving the accuracy of financial reporting. So the bottom line from this slide is that shorter termination timelines help agencies free up funds sooner, improve financial visibility, and keep contract actions from remaining unresolved longer than necessary. Now, FAR Part 52 is all about solicitation provisions and contract clauses, and I've called out a few here that impact financial management directly. Everything in FAR Part 52 is where policy becomes contractually binding. Anything that is a solicitation provision is going to be language that is written in the solicitation before the contract is awarded, and then the contract clauses are actually applied once the contract gets awarded, and they're going to be listed in the solicitation as well, and they are legally binding. So this is where the rules we've been discussing get translated into the clauses that actually govern that particular contract. While financial managers typically don't select the contract clauses, these clauses have a direct impact on your work because they establish the rules for payments, financing, inspections, changes, government property, option years, and terminations, all of which influence funding, financial oversight, and contract execution. One of the goals of the RFO was to make Part 52 easier to use by consolidating the active standard clauses and removing expired or duplicative language, which means less time searching through outdated text and more confidence that you're working from the current clause language. And I can tell you, it is quite a bit different if you are familiar with FAR Part 52 in the past. What you see today is a lot more streamlined and shorter. And I think that's a good thing. It helps us navigate it easier, and it'll help the contractor, I think, remain compliant a little bit easier because there was just so many alternatives, and now some of those have been removed. But as the FAR becomes less prescriptive, it's even more important to understand what the contract actually says. The financial impacts could include things related to reporting requirements, invoice documentation, contractor responsibilities, and funding implications of modifications or amendments, as well as future year commitments that are created by option years. So the takeaway is that I don't want you to assume that every contract works the same way. Again, make sure you're paying attention to when that contract got awarded and what version of the FAR might apply. The clauses incorporated into the contract define the parties' rights and responsibilities on both the government side and the contractor side. So when a financial question comes up, the contract clauses are often the first place you're going to want to look. And that hasn't changed. Now, throughout this presentation, we've talked a lot about changes to the FAR and went over some specific areas. But this slide highlights one area that has not changed. No matter how much the FAR gets streamlined, easier to read and navigate, financial managers are still responsible for ensuring that funds are available before obligations are incurred, that obligations are valid and properly recorded, and that accounting records are accurate, and that every transaction is supported by that appropriate documentation. These are not just accounting requirements, they are key internal controls that protect the agency and ensure compliance with appropriations law and other fiscal laws. So if you remember one thing from today's session, let it be that the FAR might be evolving, but the good financial stewardship requirements has not changed. Streamlining acquisition processes should never come at the expense of sound financial management, accountability, or strong internal controls. Now I want to ask another poll. What FAR part changes are you most concerned with? All right. It looks like contract administration and audit services was the majority, and that was 63%, followed by cost principles and procedures. Okay, cool. Good deal. Let's talk a little bit more about documentation. One of the biggest philosophical shifts in the RFO is the way agencies think about documentation. In the past, the focus was often on whether every required step was completed. Check the box kind of situation. The new emphasis is on whether the agency can demonstrate that it made a reasonable, well-supported, and compliant decision. That does not mean less documentation. It means more meaningful documentation. So less is more. It might be a little bit less when it comes to the rules and the information that's in the FAR, but it is more important that we document things appropriately. Your documentation should clearly answer a few basic questions. Did we have the authority to do this? Was funding available for the right time, purpose, and amounts? And why was the decision made? Who approved it? How was it documented? That information becomes especially important during an audit. Auditors will continue looking for unsupported obligations, weak approval processes, poor documentation, and inadequate oversight and monitoring. Those expectations have not changed. So while the RFO encourages flexibility and professional judgment, that judgment still needs to be well documented and sound. If you can't explain and support a decision after the fact, it's difficult to demonstrate the acquisition was properly managed. So one of the themes that we come back to is that acquisition is a team sport. No single office can successfully manage the entire acquisition lifecycle on its own. The program manager defines the mission need. The contracting officer develops and executes the acquisition strategy. Financial managers ensure funding is available, obligations get properly recorded, and financial stewardship is maintained throughout the execution. Legal counsel also is there to help ensure compliance with statutes and regulations, while oversight organizations provide independent review and accountability. The RFO reinforces this collaborative approach by encouraging sound business judgment and greater flexibility. But flexibility only works when these groups communicate early and often. For financial managers, one of the most valuable things you can do is to engage early in the acquisition process rather than waiting until it's time to certify funds or process an invoice payment. Early coordination helps identify funding issues, avoid delays, reduce rework or duplication, and ensure that acquisition remains compliant from planning all the way through closeout. As we start to wrap this up, Keep in mind, the best acquisition outcomes happen when each organization understands its roles and responsibilities and works together towards the same mission. Now, I want to leave you with a few practical actions that you can take back to your organization. First, get involved early. Understanding the acquisition strategy before funds are committed helps identify potential issues while there's still time to address them. Second, review the funding assumptions. Make sure the funding source, the period of availability, the color of money, and estimated costs support the acquisition strategy. Third, monitor obligations and outlays through contract performance. Don't assume everything is on track just because the contract has been awarded. Ongoing monitoring helps identify funding issues, potential overruns, or excess funds that may be available for deobligation. Fourth, maintain good documentation. As we discussed, streamlined regulations do not eliminate the need to document funding decisions, approvals, and the rationale behind key decisions. And then finally, communicate risks early and often. Most financial problems don't appear overnight, they develop over time. The sooner financial managers raise concerns with the program offices and contracting offices, the easier those issues are to resolve. And together, these 5 actions will help you navigate the RFO while continuing to provide the strong financial stewardship that agencies depend on. So keep in mind, and this is kind of the takeaway that I want you to pay attention to, is that greater flexibility does not mean less accountability. Yes, we have more flexibility, more judgment, and more autonomy and authority, but that does not mean we're not going to be good stewards of taxpayer dollars. We still have to make sure we're following the rules and that we are documenting things appropriately and that we have strong internal controls and so on. And so here are some key takeaways for today's webinar. Acquisition processes are changing. The RFO is being simplified and streamlined so that way agencies can acquire goods and services faster, with more innovative and competitive sources for contracts. Guidance may no longer be found in the FAR, so keep that in mind. It might have moved outside of the FAR with these other guidance documents or to other regulatory documents like the GSAR. Things like the FAR companion, practitioner albums, and agency-specific guidance exists. So know where to find them is half the battle, besides just knowing the FAR itself. And greater flexibility requires stronger controls. The RFO encourages professional judgment and innovation, but those benefits have to be balanced with sound financial oversight and stewardship. And then also keep in mind that systems often lag behind policy. Financial systems, templates, forms, SOPs, desktop guides, etc. They may not be updated immediately to reflect the latest FAR changes. So take the time to verify that you're using the current guidance and there may be some updates needed. And if so, point those out to your chain of command and make sure those get updated appropriately. And then finally, documentation. Documentation is always key, especially in an audit environment, which we have been under for well over a decade now. And with the changes to the FAR, I'm concerned that some of the documentation might fall to the wayside, and we just want to make sure that doesn't happen. So the regulations might be changing, but the responsibility to safeguard taxpayer dollars, maintain strong internal controls, and support sound financial decisions with documentation remain more important than ever. Now, here are some key RFO resources that you may want to know about. And you can find them all on the RFO website. I will pull that up real quick so that you can see it for yourself. So if you just go to acquisition.gov, you'll see some options here, and you'll see at the top FAR overhaul. Now you can go right into the FAR right here, but if you go to FAR overhaul, you will see everything that we talked about here. So here are the deviations. Here's the FAR companion document. some specific category management information as it relates to what you're buying. There's some Q&A. This is also where you can send feedback directly to the OFPP, the Offer of Federal Procurement. And then practitioner albums, as well as some searchable text. So you can actually pull out the entire RFO and it's a PDF. So you can do Control F to search for keywords that might affect your business. And then we've got our frequently asked questions and some additional documents. And here's the GSAR overhaul that I mentioned. And then here's a list of feedback that has been provided in the past and then incorporated with this matrix. So everything you need is going to be accessible directly from acquisition.gov. And then, the executive order and the memorandum from OMB, you can also take a look at if you would like. Now, I will say the practitioner albums are especially helpful because they summarize the changes and include line-by-line comparisons between the old and the new FAR language. The searchable RFO text is really good for finding things that you know by keyword, and then the FAQs are helpful as well to find for specific keywords or information based on what you do for your work. So I encourage you to take a look at these, bookmark them, and use them as you see fit based on what you do, because they can help answer many questions that you might have quickly rather than relying on outdated references or just relying on your memory. So one major takeaway, staying current is part of good financial stewardship, and strong internal controls depend not only on following the rules, but knowing what the rules are and where to find them. And with that, I will ask you one final poll. After today's webinar, how prepared do you feel to navigate recent FAR changes? Okay, good. We've got a mix. Nobody said they're still unclear on how those changes impact their roles. That's good. That's a win. A few people said that you learned some new things, but need more guidance on applying those changes. I fully understand that. And you may want to take a look at, take a look at the information that I shared, and then maybe talk to your leadership and see if there are any internal resources that have already been updated, or if there are any internal trainings or meetings or anything that might be helpful. I did see one comment here. If guidance is outside the FAR, I hope it is consistent or not conflicting with the FAR. Absolutely. I fully agree with that. It shouldn't be, based on how this is being managed and all these changes are being done by the council. I don't think that's the case, but if there is anything that you see that you're concerned about, I would recommend reaching out through the resource that I showed you on the RFO overhaul page. Let me pull it back up again. So questions and feedback. I would send an email to OFPP if there's anything you see that is conflicting or concerning. This is going to be your best way to reach out directly and let them know what's going on. And then, of course, I would recommend that you also keep your leadership informed. And with that, I want to give you some questions to consider. Think about how might increased acquisition flexibility affect your organization. Where do you see opportunities to improve efficiency, and where might additional oversight or coordination be needed? And then second, where do acquisition and financial management intersect in your role? Maybe it's funding availability, obligation recording, invoice review, receiving and acceptance, contract modification, or audit support. Understanding those touch points can help you identify where you can add the most value. And then finally, think through what controls are most important during this transition for the work that you do. As agencies adopt new guidance and update their processes, it's a good time to evaluate whether your approval processes, your documentation standards, your monitoring activities, and your communications channels are still providing the level of assurance needed. And I will open it up for any questions that any of you might have. Feel free to drop them in the Q&A, and I'll be glad to answer them.
While we're waiting on potential questions, just to answer the slides, they won't be available for distribution. However, this is recorded, and you absolutely can review this at any point in time. We'll have it uploaded on our site as soon as we have the ability to. It shouldn't be any later than tomorrow that you'll have access to this recording.
Thank you, Amanda.
No, you bet. I also see a question here for you as well. How do we know whether to follow the existing FAR or agency's RFO deviation if they don't match?
Good question. It's going to depend on what is written in the class deviations. The class deviations take precedence over the existing published FAR for the covered acquisitions included. So I would recommend that you become familiar with your agency's implementation guidance and ensure that your internal procedures reflect those deviations until the final FAR revisions are adopted. And you can get to the class deviations directly from the RFO overhaul page that I've shared.
I have another one if you have time.
Sure.
If the FAR is becoming more flexible, does that mean there will be fewer internal controls?
No, definitely not. If anything, we might see the need for increased internal controls because we still have to be good stewards of taxpayer dollars and meet the tenets of fiscal law, appropriations law, and other regulations that exist. So, if anything, we might need to strengthen our internal controls even more.
Good to know. Okay, I have one more here that we'll be able to get to, which is what changes should financial managers make to their documentation practices?
Well, documentation needs to clearly demonstrate the decision-making process. I always recommend that when you're documenting things, like especially when you talk about judgment, document your thought process. Where did you go to research? Did you read books? Did you have meetings? Keep a log of that information with the date and whoever else was present if it was a meeting. Take a look at the publication date of whatever it is that you're reading and including. Make note of it if it's a regulation or a policy or even a book. Make note of the page number and the publication date and things like that. But ultimately, the documentation, when we talk about decision making, should demonstrate that you did think through something, that you didn't just pull it off the top of your head, that you are thinking through and using resources that are available, including other documents, legal authority. And then the purpose is we want to make sure it's demonstrating that we're doing our due diligence when it comes to following the law and making sure that we show that funding was available, it's for the right purpose, it's legally allowed, and any approvals involved also should be well documented, as well as risks. I think it's important to always keep track of our risks and our considerations as it relates to our risk and any mitigating factors that we can think of. Good question.
Great. Looks like we're about wrapped up here, unless you had anything to add, Tamara, before we head off to the rest of our day.
I just want to say thank you all for taking the time to sit with us today and learn about some of these FAR updates. I hope it wasn't too much information for you. Definitely use the resources, and you know, there are some additional classes that I think graduate school offers if you want to learn more. Thank
Absolutely.
you.
Thank you so much. Thank you, Tamara. Thank you, Shige. Have a great rest of your day, everybody, and a good weekend ahead.
Yeah. Thanks, everyone.